Yo, what's good? All right, let's break down this research paper like we're chilling over some wings, talking shop about how fintechs and banks are throwing punches in the lending world. The paper's called Fintech and Bank Competition: The Impact of Lending Technology on Market Segmentation, by Konstantinos Surface, Kejia Wu, and Panagiotis Avramidis, dropped at a Crete conference in 2022. I'm going to keep it simple using metaphors like a street race or a cooking battle so you can follow along without your brain hurting. Let's jump in. Imagine the lending scene as a drag race. You got fintechs, new kids on the block with shiny tech packed rides, and banks, the veterans with classic muscle cars and deep pockets. They're both chasing borrowers, folks like entrepreneurs needing cash for their next big move. The big question here is, how's tech changing who gets what loans? Are fintechs zooming ahead, or are banks still holding the lead? It's like a cooking showdown. One chef's got a fancy robot mixer, the other's using a trusty old whisk. Um, who's going to plate up the better deal? First up, fintechs. These guys are like the Tesla of lending: fast, slick, all digital. They make borrowing a breeze, apply online, no sitting in a stuffy bank office, just a few clicks, and you're good. It's like ordering pizza delivery instead of making dough from scratch, quick and easy. They also use wild tech like AI or random stuff like your Spotify playlist history to figure out if you're a safe bet for a loan. Fintech lending blew up with business loans growing over 40% a year from 2016 to 2020. But banks, they're still in the game, playing it old school. They want collateral. Think putting up your car to prove you'll pay back. Their process is slower, like mailing a letter instead of texting, and they stick to boring data like credit scores. The paper sets up a face off: fintechs versus banks, fighting over two kinds of borrowers. Some need quick cash for short term gigs like launching a pop up shop for a month. Others need big money for long term plans like opening a chain of gyms. Fintechs are aces at spotting who's solid for short term loans, like having a better GPS in the race. For long term stuff, though, their edge fades. Banks catch up because predicting years out is tough for everyone. It's like fintechs kill it in a 100-meter sprint, but banks hang tough in a cross country run. They model this as a secret auction, like both sides bidding on eBay without seeing each other's offers. Picture a bake off where each chef submits a dessert and the borrower picks the one that tastes best, or here, the loan with the best deal. Fintechs offer unsecured loans, no collateral needed, like lending your friend 20 bucks without grabbing their phone as backup. Banks, though, demand collateral, like saying, hand over your watch till you pay me back. If you don't pay, they sell it to cover their loss. Here's the wild part: this auction has a winner's curse. It's like snagging a cheap mystery box at a garage sale, only to find it's full of junk. In lending, if you offer the lowest interest rate, you might end up with a borrower who's risky as hell. Fintechs, with their sharp tech for short term loans, dodge this curse better in that lane. Banks, better at long term bets, handle it there. The paper uses math to show how each side plays, mixing up their bids like a bartender shaking cocktails, sometimes low, sometimes high, to avoid getting screwed. So, what's the deal? The lending world splits up like a high school lunchroom. Fintechs own the short term table, handing out unsecured loans with higher interest rates since they're taking bigger risks, like charging extra for a last minute Uber in a storm. Banks dominate the long term table, offering loans backed by assets with rates that swing all over, some dirt cheap, some crazy high, like a used car lot with everything from clunkers to Ferraris. Why this split? Fintech's tech makes them better at picking winners for quick loans, so they focus there. Banks use collateral to play it safe, especially for long term deals where risks pile up. The paper says tech and collateral are like hot sauce and tacos. If you've got killer tech, fintechs, you need less collateral. If your tech's basic, banks, you lean hard on collateral to avoid getting burned. It's like a pro chef needing less gear to nail a dish, while a newbie needs all the fancy tools. Here's a plot twist: the bigger the tech gap between fintechs and banks, the less split the long term market gets. Fintechs start sneaking into long term loans, like crashing a party they weren't invited to. For short term loans, it's trickier. If banks demand a ton of collateral, fintechs back off, and the split grows, like two squads staying separate. If collateral's low, fintechs jump in and the gap shrinks. This lines up with a 2019 Federal Reserve survey where small businesses said fintechs were their plug for fast cash, while banks handled the big long term projects. Now, let's talk collateral. The paper adds a stage where lenders decide how much collateral to ask for, like setting the stakes in a poker game. It's not free. Demanding collateral takes work, like appraising a house before lending. Fintechs, with their dope tech, ask for less collateral since they trust their gut. Banks, more cautious, want more, like a pawn shop demanding your whole jewelry box. The math shows fintechs keep collateral low to stay in the game, while banks go high to cover their weaker tech. All right, let's bring it to 2025 for some real world spice. Fintechs like SoFi or Cabbage are still killing it. Apply for a loan in minutes, no bank teller staring you down. Banks like Chase are stepping up with better apps, but they still love their collateral and long term deals. The split's alive. Fintechs for quick money, banks for big plans. Regulations are getting tighter, slowing fintechs a bit, and banks are using AI to catch up on screening. It's like both teams upgrading their cars for round two. What's this mean for you if you're an entrepreneur needing cash for a quick hustle, like a pop up merch drop? Fintechs are your spot. Higher rates, but no assets needed. For a long term move like opening a brewery, banks might offer better rates if you've got collateral. Investors? Fintech stocks could pop for growth, but banks are the safe bet for steady gains. The paper shows techs splitting the lending world like a DJ splitting tracks. Fintechs take the fast bangers, banks the slow grooves. To wrap it up, this paper is straight fire for seeing how tech shakes up lending. Fintechs go short, unsecured, high rates. Banks go long, secured, wild rate swings. As tech gaps grow, long term lines blur, but short term depends on collateral. Questions? Hit me like fintech or bank for my startup. Short term fintech, long term bank. Is this split still real in 2025? Yeah, but banks are closing the gap with tech. Thanks for hanging. Share this with your crew, drop your lending stories in the comments, and let's keep it 100.